How much money do you need to invest in real estate? I bet it's less than you think. Hey guys, it's Dave from BiggerPockets, and you probably know this, but houses are expensive right now. If you've bought a home in the last couple of years, or maybe if you've tried and unfortunately haven't succeeded in buying a home right now, you definitely know this. It's one of the biggest stories in America. And I think this broad general housing affordability crisis scares a lot of people away from investing in real estate. But I'm here to tell you that it shouldn't. The median home price nationally right now is about $420,000, which means that if you want to put the traditional 20% down for a conventional mortgage, for $420,000 plus closing fees and some reserves, that's going to come close to $100,000 in liquid cash. And if you're like most people and don't have just an extra $100,000 lying around, you might be thinking, there's no way that I can invest in real estate. I can't even buy a single house. But you don't need $100,000 to get started investing in real estate and take your first steps towards financial freedom. It's actually not even that close. So the question is, how much money do you need to invest in real estate? And I like to think of this question in tiers because you can invest almost any amount of money in real estate, but depending on which tier of cash you have to invest, there's going to be different strategies available to you. So I'm going to tell you what each of those tiers are and which strategies you can consider based on how much money you have available to invest today. And just to caveat this, these numbers are if you're looking to invest in a market where home prices are close to that median of $420,000. There are, of course, markets where you can buy a house for $150,000 and invest with less money than the numbers I'm talking about. And then, of course, there are markets like New York or San Francisco that are so expensive that even if you have millions of dollars, you probably do better investing in something else. So these tiers are just ballpark national numbers. All right, so tier number one, this is the lowest tier, and to me, it starts at about $20,000 and goes up to $60,000. Now, of course, it's possible to invest less than $20,000. If you had $10,000, you could probably buy into a small equity piece of someone else's deal, or you could do that on top of property managing for sweat equity, and those can be good ways to get started, but you're not going to have a lot of control over the deals that you're involved in. If you have at least $20,000, you have at least two options. The first is house hacking, and the second is partnerships. Now, we talk about house hacking a lot on this channel. It's because it's a great way to get started, but I just want to demonstrate for you with $20,000 how valuable house hacking can be. One of the many reasons we always recommend house hacking is because you can put as little as 3.5% down, which means that if you have a $20,000 budget, you can buy a house worth $286,000 and still have money for closing costs and cash reserves in case something comes up that you need to fix. That's actually very reasonable budget for single family homes in many markets. In a lot of places in the Midwest, some places in the Northeast or the Southeast, you could definitely buy a really nice single family home for $286,000. You can live in one bedroom and rent out the others. And in certain markets, you can buy a pretty nice duplex for that. One of the markets I invest in the Midwest, I've bought a house in the last year, a duplex for $252,000. There are cheaper ones than that, especially if you're willing to do some work to renovate them. Of course, again, this is the lowest possible end, so you're not going to be living in a luxury duplex for $286,000 in today's day and age, but you can get yourself into a solid deal with $20,000. And if you go all the way up to $60,000, then house hacking is going to be available in the majority of markets because your budget's going to be over $600,000, over $700,000. So that's going to be available if you're sort of at the higher end of tier one. The second option in tier one is partnerships. And these, of course, can be structured in any way. But the general idea is if you have somewhere between $20,000 and $60,000, pool your money with someone else and invest in some sort of deal. My first deal, I partnered with 3 other people. And I know a lot of people, when they're first getting started, think that partnerships are complicated or not a good way to get started. But I will tell you that the majority of real estate investors partner on most, if not all, of their deals. It's just a good way to diversify, to borrow expertise from somewhere else. It's not even that you're just getting money from other people. You can also partner with someone who knows more about real estate than you do. And that means you can leverage their skills and experience to increase the chances that your deal is a successful. Now, at $20,000, if you're investing in a cheaper market like in the Midwest, you might be able to be a 50-50 partner with someone. But if you're investing in a more expensive market, you're probably going to be a quarter partner or a third partner. And honestly, again, that is okay. The goal of your first deal to get started in real estate should be to learn and to just have a base hit. And bringing in partners who are really experienced can be a great way to do that. So for tier one investors, which again is if you have from $20,000 to $60,000, should consider house hacking in a cheap to medium price market or partnering with an experienced investor to get into your first deal. All right, moving on to tier two. This step up goes from about $60,000 in investable assets up to $100,000. And as you can imagine, if you move into tier two, a whole new world of opportunity is going to come to you. You're going to have a lot of different strategies that you can consider. I'll first mention house hacking again. At this price, you can house hack basically in any market in the United States. If you're house hacking with $100,000, you can even house hack in San Francisco or New York or Seattle. All those housing markets are going to be available to you. I don't know if it makes sense, to be honest, to put 3.5% down and house hack in those markets, but you could mathematically do that. So it is something that you can consider in any market in the US. And of course, you can partner too. But what really opens up to you in tier two is just being able to go out and buy rental properties that you own entirely. Even at the low end of this tier, at $60,000, if you put 25% down, which is what most investors do, you're going to be able to go out and buy properties that are worth a minimum of $200,000. Now, that's not available in every market, right? You're not going to be finding that on the West Coast, but there are absolutely markets where you can buy single family homes that are under $100,000. A lot of them are going to need work. In some markets, they actually might not need work. But again, this is going to be sort of the lower end of this tier, and you don't want to partner. But as you get higher up in this tier towards $100,000, that means you can go out and buy a property worth $400,000. And that really is where things get opened up, right? Because as I said, that's about the average price in the United States. And in great markets, for example, like Tampa, Florida, the median home price is $375,000. So if you have $100,000 to invest, you can put 25% down and go buy the average price in a great market like Tampa or in Charlotte. And so that's where, again, things really start to open up. If you want to buy a multifamily property like a duplex or a triplex, you're going to again have to favor towards those cheaper markets, even in tier two. And if you're going to want to do a rehab, you probably want to target a cheaper property, right? Because if you need $20,000 to do a rehab, you might want to start looking for properties that are sort of in that $250,000 to $350,000 range and save some of that money to do a renovation. But again, in tier two, all this optionality becomes available to you if you have between $60,000 and $100,000. All right, moving on to tier three, which is more than $100,000. Of course, you can just extrapolate from what I've already told you and just go beyond that. Like if you want to buy rentals above $360,000, you can do that if you have $100,000 or above. You're going to be able to buy single family homes in most markets in the US and duplexes in most markets, even at the lower end of this tier if you have $150,000. The thing that really opens up to you over $100,000, in my opinion, is passive investing opportunities like investing in syndications or private lending. This allows you to invest in big multifamily projects, self-storage units, rentals, office, whatever you want to invest in without taking down the whole thing, right? If you want to buy a 50-unit multifamily property, it's probably going to cost tens of millions of dollars. You probably don't have that lying around, which is why investors pool their money into syndications. But for a lot of syndications, actually most of them, the minimum investment is at least $50,000, and a lot of them, the minimum is $100,000. So you need quite a lot of cash to be able to participate in these bigger deals. And I want to caveat and say that this doesn't mean that there are better options just because they're bigger. Actually, smaller deals have performed better than bigger deals over the last couple of years. But if you want to just get into real estate and you want to be more passive than going out and buying a bunch of properties, if you have $100,000 or more, you're going to be able to participate in these syndications. You can even consider doing some private lending. And that allows you to really diversify, not just among all of your investments, but it allows you to diversify within the real estate asset class between rentals, multifamily, retail, self-storage, all these different things. So that's really what opens up to you in tier three. Of course, there are infinite more tiers that you can have. If you have hundreds of thousands or millions of dollars that you can invest, you could start buying properties for cash, which is a whole different thing. But I think for the vast majority of Americans, the way to think about real estate investing is in these three tiers. Again, tier one, if you have $20,000 to $60,000, you can consider house hacking and partnering with people. If you do at any point move to tier two, that means that you can start buying rental properties in your own name without partnering with people. And if you move to tier three, you have the entire buffet of real estate options available to you, including more passive strategies. Now, before we go, I just want to make clear that just because there are different tiers doesn't mean that you have to move from one tier to another. You can achieve financial freedom. You can find great deals in tier one. You can do almost your entire portfolio and spend most of your investing career in tier one and tier two and never move on to syndications. I actually know a lot of investors who have done that over the course of their career. So don't worry about moving from tier to tier. Just figure out how much cash you have to invest today and which option within your tier is most appealing to you and best supports your long-term goals. So that's it. That's how much money you need to start investing in real estate. I hope this was helpful to you in illustrating that the most important thing is just getting started, and there's a good chance that having enough cash to invest isn't actually the barrier to entry you might have thought. Thanks for watching.